All of us here at BARR Financial Services would like to wish you a happy new year, and we are looking forward to another beneficial year. This is our market commentary for the fourth quarter of 2010. Many of you have commented that you appreciate all the work that goes into producing these commentaries to bring you up to date with our views of the economy and the marketplace. What a year it has been. After getting off to a rough start and having a volatile summer, equity markets have rallied to finish a strong year. You may recall in my commentary 1 year ago, that was our anticipation of how the year would go, but nobody gives me any credit. As indicated by the graph, the S&P 500 index climbed 10.8% for the fourth quarter and is up 15% for the year. Buyers returned to the equity markets with enthusiasm in December as a number of positive economic reports emerged and the holiday shopping season was reasonably encouraging. The strong performance brings the stock market rally, which started in March of 2009, to an overall growth of the S&P of 93% and is just 13.6% below the peak reached in October of 2007. There are many that believe we could reach these levels by the end of 2011. A driving part of the rally was the recovery in consumer confidence. While high unemployment and weak job creation does not seem to go hand in hand with consumer confidence, one must remember just how low confidence had fallen. Cash on corporate balance sheets has continued to rise and now accounts for 30% of current assets. In recent quarters, companies have increased dividends, share buybacks, capital expenditures, and merger and acquisition activity. That this can occur while increasing cash holdings speaks of just how cost-conscious companies have become, which has led to high profitability. The Conference Board's leading economic index, LEI, for the U.S. increased 1% in December. This is an indicator of the economic activity over the next 3 to 6 months. Ken Goldstein, economist at the Conference Board, is quoted as saying, "The 4-month rise suggests the economy now has some wind in its sails. However, it still faces some strong headwinds in the medium term." He went on to say, overall economic activity is likely to continue to gain momentum in 2011. Stock valuations look attractive based on almost all valuation models. As we review the S&P index at inflection points, we can see it dropped 57% during the recession and has rebounded 86% by the end of the year. It would appear there is room for continued growth as compared to the past recession. The forward PE ratio of the S&P index most recent reading of 13.1 times is well below the average of 16.5 times, again suggesting stocks are still undervalued and have room to grow. This is a reflection going back 16 years to 1994. Delinquency rates on residential mortgages, consumer loans, and commercial and industrial loans have all been reducing through 2010. This is an indicator of early signs of stabilization in consumer debt and the real estate markets. Outlook for 2011? First, our positive view. The U.S. economy should continue to grow by 4% in 2011, its fastest pace in 6 years. The prospects of a double-dip recession has now diminished to barely 15%, and the outlook for 2012 should improve as well. The positive economic backdrop should ensure another solid year for stocks, with U.S. equities being one of the best performers. But volatility will continue. The growth in the U.S. economy should increase job creation, dropping unemployment considerably. Now our realistic view. Volatility will keep us on our toes as we move through 2011. Currently, the market stress points are high, and we could experience a short-term correction in the markets before they continue to climb higher. Despite strong results across asset classes that began in 2009, the global economic environment remains cloudy. Government deficits threaten to strain growth, and recession-fighting monetary and fiscal policies may well spur inflation. We anticipate a similar year as 2010, with volatility in the market, but we do expect continued growth in the economy and the markets. Possible setbacks to consider in 2011. Defaults by state and municipalities could trip up the economy and disrupt growth for the year. Although the rhetoric has recently cooled between North and South Korea, there's a high risk of another military confrontation between the two. Iran has focused blame on Israel for launching the computer virus, which has crippled their computers at the nuclear plants. This could increase terrorist and military attacks against Israel, and Israel could retaliate. The government of Pakistan shows more signs of weakening, which should increase the concern over the security of its nuclear arsenal. The combination of stronger global growth and rising international political tensions could push oil prices over $100 a barrel. The impact on the economy will depend on how high prices go and how long they remain at these levels. Long-term issues. The main economic focus has to be job creation. It is estimated that somewhere between 50 and 70% of the rich are small business owners, and small businesses are the backbone of job creation in the U.S. Unemployment must be reduced before any substantial improvement in the other major issues can take hold. These issues include the real estate market, the national debt, the U.S. deficit, the Eurozone issues, and remember, the election is just around the corner. Our portfolios performed well during the volatile year of 2010, and I firmly believe that the diversification of our investments will continue to be beneficial as we move forward into the uncertain future. Please forward these commentaries to your friends and family and let us know how we can better serve you and your needs. Thank you for listening and your continued confidence.